First off, I recommend to all of my clients take stock of what statements you've made, so you at least have an understanding. And if you need to start pivoting it, do it thoughtfully, do it carefully. I think it's important to just kind of set the groundwork for where we were and where we are now. As all of you know, kind of leading up into the pandemic and early days of the pandemic, I think there was an overwhelming view that all of a sudden we can do well and do good at the same time. There was this kind of confluence of consumer perception around doing things well for the environment and decarbonizing, and I'm talking about in the public markets in particular. And a lot of funds kind of rushed in they saw a lot of dollar signs. They know that sustainability sells, and so they wanted to market their funds and position themselves in a way that was capturing some of that demand. That's all well and good, and I would love to see sort of capital deployed in a way that makes a positive impact on the environment and communities. However, I think that also then kind of ran headlong into some pretty strong macro headwinds that we've seen in the last couple of years. A much more challenging operating environment for a lot of companies. You're seeing energy prices spike with the Ukraine war, so some of those kind of decarb plays have been maybe a little bit less successful than maybe we thought they were going to be. You also, just in a low inflationary environment, you can kind of play a little bit more with some kind of longer term horizons, but now it's hard to make some of those longer term capital plays. And so that's been kind of just a sort of practical reality of this.
Well, great. I mean, so the fund started back in '99. So this was the first internet boom in the late '90s, and the two founders started the fund with the idea of deploying capital where capital wasn't going. So there's a lot of venture capital going to sort of tier one cities, and so they started the fund as a CDFI, a Community Development Financial Institution, and they were explicitly not citing market rate returns. This is 25 years ago when they founded it, and so it was going to regions where it was driving low and moderate income job creation. So SJF used to stand for Sustainable Jobs Fund. That's what it originally stood for 25 years ago. In the middle of that fund, the bubble burst, and I think the two founders had a recognition that a fund that was not citing market rate returns was not going to carry the day for subsequent funds. And so in the middle of that fund, they said, well, let's sort of pivot and drive towards market rate returns. And so the impact mandate of the fund has stayed with the organization since then, but that impact mandate has expanded. So when it first started, it was around this job creation in low and moderate income communities. That's expanded to include the areas that I mentioned before, which is clean sustainability, health and wellness, education, workforce, GovTech.
First off, I recommend to all of my clients take stock of what statements you've made, so you at least have an understanding. And if you need to start pivoting it, do it thoughtfully, do it carefully. A lot of folks, maybe set a net zero commitment a couple years ago, and now they kind of wish they hadn't, and they're just sort of all of a sudden stripping it out of their communications. It's not that hard for a canny person to run a red line between two sustainability reports and figure out, wait, you're no longer committed to net zero. What's up with that? Were you lying then, or are you lying now? And so that's a question that I think people need to really think about carefully. And if you are going to be making an adjustment or sort of pulling back a commitment or changing something that you've stated publicly, try to have a good story behind it. That's what a lot of what I do is I help my public companies in particular engage with their investors. And so having a dialogue with them, I think, is really credible.